Hello and welcome to the super packed weekend video, which is called S&P 500 Have we seen capitulation? We will dive into volatility signs, currencies, US dollar as such, and of course gold, silver, miners, oil and copper with Bitcoin individually, including international markets. So this is going to be packed and you want to watch it from the beginning till the end. Starting with the weekly chart, and you notice those two very prominent rising support trend lines. One has been broken long ago and the other one is on the verge of being tested, and it's the one connecting the oversold rally from oversold levels in October 2022, which had marked the bottom of the prior bear market. So the very valid question that we will be looking for answers within this video, that I will be presenting the clues and sharing some of my opinions, is whether we are within a correction or within an unfolding bear market, whether things get worse or whether the worst is already behind us. So much for the weekly chart and the importance of the moment that we are right in. Have a look at where those percentages of stocks trading above 250 or 20-day moving averages had been back then, where they had found themselves at the yen carry trade of August 2024, and where it was when the market was still fearing more Fed rate hikes in late October 2023. So this is quite incomparable, and only the oversold bottom of 2022 quite compares to the situation where equities are right now. And we have already seen a lot of steam come off from the PE, from the multiples. There is worry about earnings ahead, about tariffs impact on the cost basis, and so on and so on. Daily chart shows the very steep turn of expectation and prior trial balance as to those tariffs being more on the targeted side. But what did they turn out to be? They turned out to be going after the actual per country balance of trade, meaning getting the US deficit in the current account more under control. And this is reflecting that why was Friday's candle as steep? There were two key factors that overpowered several good opportunities, and I will discuss them right on. For now, I want to make the point that the McLaren Summation Index, which is still a very long-term metric of the stock market breadth, is pointing to further deterioration. And you remember from prior extensive weekend video, to which I will be linking. Thank you for liking these videos and subscribing to the channel. That way you will benefit immediately whenever new, in-depth or very timely and punchy and short content goes up. I've been adamant that this is not a healthy sign of consolidation or bullish divergence in the making. Things are still on a relatively shaky ground from this perspective as well. And now let's go to those two key factors that had knocked equities so much lower on Friday. First was a well-timed Chinese response to tariffs 34% tariffs of their own. And of course, rare earth minerals. They also hit where it hurts. And there it hurts most. US has the mines, they have not been largely licensed, and most of all, it does not have the refining manufacturing capacity to turn those rare earths into a readily usable input for its tech industry. So what good is great AI infrastructure where there are bottlenecks in terms of electricity, utilities, and those essential rare earths by themselves? Forget not that in certain elements of these, because that's a group of elements, China controls up to 90% of world mining plus refining capacity. The higher of the two percentages I gave you by stating it's up to 90%. So just consider that this is multiple times bigger control over the market than OPEC has over oil. And we will dive into oil still some more. But for now, let's say that those China tariff response, it had been quite retraced for good 3 hours. Nothing had been happening. Then I had been predicting that non-farm payrolls would not be as bad. And they were not. They were actually very good. So those private payrolls, the job creation there was, had turned out quite smashing. And only following the opening bell, sellers returned, and I as well predicted that there would be a boost around Powell, and that's the long upper knot, or reaching all the way to the China tariff announcement bottom, and since then the selling in equities had ruled, and it had backed several important developments, such as in the US dollar, where Powell's speech had worked to stop rates from retreating, and it served in defense of US dollar, sending it up versus several key currencies. However, in spite of this usually positive development, because whenever the US dollar rises, there is more of an incentive for international money flows to go back towards United States, which was exactly the factor which had brought S&P 500 back above the 200-day moving average and coincided with full 1 point in USDX ascent that I had called 1 to 2 weeks ago, and that's been negated as well. The volatility metrics that we will review further on had been also hammered back and closed near their highs. So much for the hypothesis of capitulation. Anyway, you can see that however easy this might be looking for intraday traders, whether it's on the upside or on the downside, meaning going trying to time the counter trend bounces, or just sticking with the trend and not betting on any pre-Monday bullish positioning in expectation of maybe some country-specific deals being hammered out, and we got quite a few swallows in that direction. Let me cite Vietnam, that had proposed dropping all its tariffs in exchange for US dropping those new tariffs, because frankly the manufacturing industry and export industry is hit very hard, which made me call for some specific movement early Friday, right after those China tariffs as regards clothing and footwear industries in the US, like Lululemon. Just to finish that thought, it might look very easy, but intraday traders must think in terms of risk-reward ratio, whether the position is good for initiation of fresh positions, given that barely a couple of hours are remaining till the closing by Friday, and there is going to be a significant move, significant gap, and I'm on the record as saying as not expecting Black Monday, meaning Monday crash. So now let's stick with the bond market, where I had been discussing prior Friday's very important turn in this bond market chart. Could we say that junk corporate bonds have found the bottom and meaningful buying appetite? That would be jumping a gun, and I would not say that everything is over in here. The upper black line that is curling to the downside, that's the TRT. So there is, as a result of Powell's speech, Powell not giving in and continuing in the largely symbolic QT of 5 billion a month, there is no willingness to price in earlier rate cuts. Powell is still holding the line, and I did not expect him to suck up. Now, when it comes to this picture, this is leaning on the risk of side still. Yields as such, 10-year to 2-year, we see that there is strong willingness to park money in the short-term debt, where yields had been hammered lower. However, on the 10-year, the push to the downside did not last. It did not. And it of course has its mirror side in the currencies market. This is the pure 10 to 2-year spread, and we see it rising. You remember through the years, almost everyone had been talking and scaring the bejesus out of you with recession. Now yield curve is inverted, panic, and it's frankly no longer the case. We can see that even before elections, it had moved over to the positive territory. So where do we have that recession? It's nowhere near. But at the same time, the odds of a recession had been creeping up, which means only that we are not in any kind of a 2008 style of a recession. At worst, it would be a very quick, sharp one, depending on how the tariff the reciprocal tariff situation and namely the response goes. We had seen China respond, but Hong Kong shied away from imposing countermeasures. So let's see how many countries would be willing to jump on board. And well before China announced these, I picked 3 main candidates for responding. And it was basically a timing question. I favored them giving more time to negotiations behind the scenes to take place through this weekend. I'm recording this video well before 7 o'clock in New York Saturday. Thank you for liking it, and I count it on early next week announcement of countermeasures, but China did not shy away from that, and that's what messed up with with carving out the daily bottom and seeing more of a downside only early next week. And the 2 other candidates, Germany and France, which are by the way poorer than Mississippi, are their response and the EU response I expect only next week to happen. So that would be adding more to the tariff fears turning into global recession fears. But the point of this chart had been to show just how poor a timing tool yield curve inversion is, and that this spread is already for well over half a year positive, and it's rising. Moving on now onto the US dollar, and this has been at slightly below 102 on Friday, where I had been saying that US dollar is in no more appetite to decline, and sure enough, it had risen. It had risen as well against safe haven currencies, as we will see in the following parts. That has been a very important sign, which could have coincided with more of a stabilization in S&P 500 in the final, say, 2 to 3 hours. That didn't happen, so the veritable hypothesis to examine is whether we are going to see such a default reaction from equities later on. This is where the US dollar appreciation came from, mainly from rising versus the euro. It had of course regained some ground versus Japanese yen too, but it had not been as profound, and the same is true regarding the Swiss franc. The sentiment, mind you, this is measured on Wednesday, so this is still before that reciprocal tariff turning more than a reciprocal situation, and that means that here the green field of bulls is probably somewhat overestimating the current situation, which should be erring more on the negative side, and to the strong bears, the red bar is and should be already bigger, so that would be speaking in favor of a capitulation bottom being in quite near. financials that had been the best factor / hope of stock market bulls, as it was fighting for the 200-day moving average, and not even the subsequent upswing could make a higher high in financials. And this is more about worry about the US dollar, because you can see as well here that they come for the generals last and financials could not catch a bid, while the dollar did catch a bid. So this is a sign in itself. Looking at the 5-day sectoral view shows that high beta is getting hammered, and only those defensives such as staples, utilities, and it's pitiful that SA Valuable declines by 6 to 7%, but that is through real estate and healthcare, and it's among the best performing sectors through the week. So much for the stock market repricing of new macroeconomic and fundamental realities when it comes to free trade. International markets, DAX quite nicely mirroring the slide in S&P 500, and Europe, in my view, has to prepare for an influx of Chinese products in the months ahead. So this is going to be an additional factor. So no buying in DAX, and I did not expect it. There the point was seeing the degree to which US dollar recovery would help bring fresh capital into US equities. However, that has not been happening, and the institutional positioning is for more pain ahead. It's been largely the retail investors who had been to a good degree already Thursday, not just Friday, buying this slide. Chinese stocks are not nearly as panicked, and that's an additional sign of one, counting on a strong domestic response in support of Chinese economy, mainland Chinese, and of course as well it's a sign of ongoing decoupling. So let's see how successful Chinese are in finding fresh export markets. Volatility clues when it comes to the bottom. VIX, it had not been that high for most of the session. It closed at its highs and had been rising, following Powell holding the line, and is it still? Does it look enough of a capitulation to you? This chart by itself would meet those criteria of a capitulation. VIX to short-term VIX, forward-looking VIX. There, the picture speaks for a bit more pain still, a bit more. But as well, this is quite at very spiky levels. So that's why I say that the local bottom, because remember, hear me clearly, this is about adjusting to new economic realities and to fix and to influence trade flows, US trade balance. That is not a subject of a couple of days or weeks worth of tariffs. That takes longer for supply chains to adjust to this shock. So much for this volatility metric, which does not personally look totally toppy to me, and that means that and it would as well line up with the expected European response next week, bearing any kind of breakthroughs happening this weekend, that we are in still some more, little more pain before finding a local bottom in the continued adjustment to new economic realities. So much for this, and final look is at the daily volume Friday. It's high, meaningfully high. It's of course not at the OPEX high levels, but still, is it good enough for a capitulation? We have had a good chunk of the capitulation move already in, and that's the objective chart supported conclusion that one can draw as we are navigating between several hour windows of expected economic predictions and Fed policy speeches that had not been bringing material surprise to those of you who have been in touch with my predictions, before these events. It was basically the timing of China countermeasures and the selling following US opening bell, totally negating and erasing good non-farm payrolls. And now let's dive to those easiest markets that have been bringing most profits to clients, and that's been, of course, real assets, where I had been since the beginning of the week cautioning about the necessity to be very protective of existing long gains. Gold, it's frankly overbought on every time frame, and its decline has been relatively has been leaving it in the strongest position. See silver, how it took a dive, and as well gold miners. So does this look as capitulation? In my view, gold is awfully close to a bearish reversal, breaking solidly below 3,000, and I had been clear already on Friday, as well on Friday when it was locking in gains, that I do not trust this gold upswing and that precious metals would tank later on, and oil is in a no-go zone either for longs. So clients were ready throughout the weekend. It had been one of those weeks when it's easier to be reading real assets than adjusting every counter trend, adjusting to every counter trend rip as the tariff uncertainty gets resolved with a meaningfully stronger bang to the downside than many, including big players, had been positioned for. So clearly the objective that I had been talking all the time had been to defend the US Treasury market, because the smooth financing of debt issuance and skewing the ratio more towards a long-term debt, which is the subject of Mar-a-Lago Accord, which I have been bringing up at least in passing, because back then it had not been a mainstream opinion over, say, 5 to 6 weeks ago, if I remember that correctly, but faithful and loyal viewers of these videos had been ready for that, and I had been questioning that point and spinning the greatest responsibility of the US Treasury towards the defense of smooth debt issuance. That necessitates having rates lower, and whatever happens to the dollar, it simply happens, and it was Powell's speech that helped lift US dollar Friday. And of course that takes steam away from gold, silver and miners and various other real assets, because one element of it is the protection against inflation, and for all the disconnected and rising consumer inflation expectations, inflation and other metrics of inflation are not pointing at surging inflation that ahead. As said, we are not on the immediate doorstep of a strong, lasting recessionary turn, but this is what had been euphemistically called as detox, and it of course takes its toll on real assets as well, because the question mark is over the economic growth ahead, not just within US, but the tariff knock-on effects for the rest of the world. How many percentage points and whatever behind the decimal it takes with it. So such is the overall situation in precious metals, and let's go one by one. Awfully close to a bearish reversal and a short-term setback, counting rather in weeks than in days. So that's the gold chart, where I see the level below 3000 as one to be easily beaten to the downside. However, remember that gold is most prone to rise and most happily rising on any turning up the heat headline, and it's only when those who are underwater in other areas have to cough up some collateral, and then that's when gold gets hammered, and even more so in the kind of leveraged place on steroids such as silver, or even the lately well-performing miners. So my word of caution for those saying that this 2950 is the bottom in silver. In my view, it is not. Same for this best known ETF, the GDX, or similar conclusion you can arrive at from looking at the GDXJ as well, where it's only the volume that meets the capitulation conclusion. However, I do not think that this move is over, and the call made to trading signals clients about the necessity to protect gains already Tuesday had been spot on, and they had been saved from all this downside. Crude oil, coupled with the OPEC action, it's going through and going into my ultimate target in the 50s. In the 50s, exactly. This might easily go very noticeably below 60. So that's what I'm looking for in this market after rare Sunday, advising clients that oil is, to the contrary, going to rise on those Iran war drums beating, which is exactly what it did. However, that reliable 72 to 72.50 area had stopped West Texas Intermediate. So much for which way oil, and as per the next chart as well, copper sees the tariff impact. One thing is the US tariffs themselves. The other one is facing the reality of a full-fledged global tariff war. So this is why Friday's candle had been this much negative in real assets, and of course that has influence on Bitcoin too. However, this had been holding up. Still, it is above 83, 82. However, I do view it as a flag-like structure, basically a second flag after the first one, early after March 10th, forming the long one, which is more of a channel than a flag, but this one can still turn into a short flag. And I do not think for all the Friday's resilience when Bitcoin scored an up day, that this would hold, and my ultimate target given to clients in somewhere in the 70s is still valid, and I do think that Bitcoin is still poised to go south. Remember, Powell had not yet capitulated. There is not going to be any rate cut soon, nothing emergency. He did not commit to anything. This is like a replay of 2018, and you know what it took, what we experienced since those beautiful Christmas 2018 with S&P sliding in a week to terrible numbers. If I remember correctly, it was around. Well, I will not be throwing the numbers here, but you can look up for yourself that it was somewhere into those 2,300. We are not on the doorstep of a similar flush, but this is just to illustrate what happens if the Fed is bucking market expectations. For now, it is not bucking market expectations that much as it is bucking Trump's calls for rates to go down. So that kind of a steep reaction in risk-taking as seen on Christmas 2018 is not going to be repeating itself. This is more of the Fed recognizing that slowly those cracks would start appearing in the job market, and that there are more of inflation worries on the downside rather than on steep acceleration, because always a part of tariffs, a good part, usually it's something between half and 2/3 of the tariff cost is being absorbed by the producer and by the middleman, and only roughly 1/3 of it is passed on to the consumer, so the impact on the US consumer would not be as bad as it looks at this moment. So the wheel of inflation would not be turning up as fast as it's being feared. However, the Fed is not clearly accommodative at this point, whereas Europe is and China is. So these major economies are going to be attracting more of those capital flows, because whatever flows into the US is a function of how the US dollar is as well performing, and all the stellar hopes of deregulation and pro-business policies have given way the more tariffs came into spotlight, starting with focus on Canada, Mexico and China only. And that's where we are after the end of winter this year, a couple of short months ago. And where have cryptos gone since? Exactly. So this points as well to more pain ahead in Bitcoin. This is not my statement about long-term Bitcoin prospects, which are bright, probably not as bright as calling for $1 million or whoever is from ARK or Strategy calling for that. I'm not on board with these figures, but still the long-term future for Bitcoin is bright. However, I do see more short-term pain ahead and a solid break of 80,000 level to the downside, because those March 10-11 lows, these would not hold. Absolutely not. My joint page will help you select what's right for you based on what and how you trade. Thank you for liking this video. Combine the daily analytics together with intraday updates delivered over Telegram. That's your best chance to keep up to date with everything that I do around the clock. You know my journey, and of course obligatory disclaimer, and have a smashing weekend.